Inflation, record COVID numbers, and an unresolved standoff with Russia, leaving us with an uncertain start to the new year. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the Fed aiming for that soft landing.
We have a massive, overheated labor market.
And former Fed Governor Dan Tarullo on Chair Jay Powell's challenges in a second term.
The Fed will sometimes hit the brakes extremely hard and thereby cause a recession. Engineering the proverbial soft landing is not an easy thing to do.
It wasn't just the winter cold snap that may have sent a shiver down your spine this week. Wednesday, we heard what we had suspected. Inflation last year was the worst it has been in nearly 4 decades, up a whopping 7%. Here's American Action Forum President Douglas Holtz-Eakin.
They do have a real problem. There's real heat on these inflation numbers.
And all that inflation certainly has the attention of the Federal Reserve, as Chair Jay Powell testified at his Senate confirmation hearing that the Fed has to turn its attention now from supporting the economy to making sure inflation doesn't become a long-term problem.
We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched.
And if all that weren't enough, Russia came to the table with the United States and then with other NATO allies to talk about all those Russian troops massing on the Ukraine border. And the parties basically agreed to disagree, at least for now, leaving prospects of a further invasion still up in the air, which was part, but only part, of what drove oil prices up this week. Here's IHS Market Chair Dan Yergin.
There's geopolitical anxiety feeding into the market on top of a tightening market that's coming with economic rebound.
3 big banks reported their earnings at the end of the week with something of a mixed bag. JP Morgan reported record profits, but disappointed a bit on trading and is adding to its costs. Citi also came up short on trading in the midst of a major restructuring there. And Wells Fargo said its tepid loan growth in the fourth quarter should pick up this year. Going beyond the banks, the markets overall, well, they had a volatile week, responding to the high inflation numbers, the low retail sales numbers on Friday, and the testimony of Fed Chair Jay Powell that reducing monetary policy support is now a certainty. Stocks fell for the second week in a row, with the S&P 500 and the Nasdaq both off about 0.3%, while yields on the 10-year climbed 125 basis points, ending the week at 1.78. That's the highest level since the pandemic hit. To put this rather confusing week in perspective, we welcome now Bob Diamond. He's Atlas Merchant Capital founding partner and CEO, and Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. So, Joanne, let me start with you. With respect to equities in particular, typically when the interest rates are going up, that's not necessarily something all equities like. Did equities respond that way this week?
Yeah, David, and they've responded that way, since the late fall. When I think it became finally clear to investors that interest rates would have to go up, given the level of inflation we're seeing, the tightness in the labor markets, and the slowness with which supply is coming back online. And so, yeah, we certainly saw valuations come back and some come down in some places more than others. And, that we just don't know for how long that's going to go on, which points to that big question that investors always face. Do you try to time this market, or you just hold on for the long haul?
So, Bob, what about the Fed trying to time bringing it back down again? How risky is that? Because the track record on these so-called soft landings is not a great one.
So, David, we talked about this, when we talked in December. The Fed needs to begin moving. As of today, they're still very, very easy, ultra easy, I would call it. The balance sheet is still expanding. They're still almost $100 billion in security purchases each month, and I think it's time that they get on with it. So I think the sooner they begin this process of kind of easing into an economy that has recovered and is growing and has a very, very tight labor market, the better.
At the same time, Bob, you've got Omicron out there, you've got the COVID virus, and so you can't quite know where the economy is going. So how big a risk is it of that so-called policy mistake, stomping on the great brake too fast and leading us into, dare I say it, a recession?
Listen, it is, everyone has said who's been on already, this is tricky. It's not 5-minute race to time this. But I think the biggest mistake that the Fed could make would be to delay too long beginning to get to neutral. And I think, David, we've talked about this before, and Joanne and I have talked about this, but when the Fed goes from ultra easy to neutral, it's usually fine for the markets. That's been the history. We're not even close to neutral yet. So when I say begin the actions, what I'm talking about is getting closer to neutral. If you look at the futures markets, then they're expecting Fed funds, not this year, but at the end of 2023, Fed funds will be 1.5 to 1 3/4. Neutral is maybe 2%, 2.5%. And then I would just bring up, it kind of ages me in my experience on Wall Street. But if you look at the experience in the early 80s when Volcker had to really, put the brakes on, short rates got to 15 to 20%. So if we talk about getting short rates, overnight Fed funds, back to 2% or 2.5%, I think that's what we should be aiming for.
And to that point, Bob, you put it really in good context, right? This is not the 80s, right? Short rates heading to 15% is very unlikely for that to be in our future. So we're really looking at short rates in the 2-ish plus % range. And also, right, this is a very different economy from where we were back then in the 70s and 80s when we had to deal with those oil embargoes and the slowdown in production. This time, the Fed at least has a tailwind to help it solve the inflation problem in that more supply is going to be coming back online this year. Just look at the semiconductor industry, which is bringing new factories up and running and will be putting out chips starting mid-year. And that's going to help by bringing up supply. That'll help close that gap between consumer demand, which is incredibly strong, and the gap in supply that we've been suffering. That should also help to bring down inflation, even as those interest rates go up.
Joanne, some people think that the 2-ish is not enough, that they'll need to do more than that to get inflation really under control. You manage a portfolio, so you don't know where it's going to go exactly. How do you manage that portfolio to make sure you take advantage of any growth that's coming your way, but protect yourself on the downside?
Yeah, right. 2-ish is still leaving real rates negative, given the level of inflation we have and are likely to have for at least another year. And so what we try to do in portfolios is to provide some positions that actually do well with high inflation, or at least are protected from it, because with that high inflation comes rising interest rates. And so you can look at various companies, whether they be banks, insurance companies, that do better as interest rates rise, but also look at some of the retail players. They're the ones that are actually raising those prices that are showing up in the inflation numbers. So they're actually a form of protection against inflation because their sales will go up, their earnings will go up. And so long as they don't have too much in the way of labor costs, because wages are a real concern here, they could potentially even protect their profit margins as they've been doing over the last year. So there are ways to build that kind of protection into portfolios, even with a rising rate and high inflation environment.
So, Bob, Joanne said the magic word, banks. You know something, a little something about banks, I dare say. We did start to get some bank earnings right at the end of the week this week. And typically, banks do better in raising rate environments. I'm not sure inflation helps them. What did you make of the earnings that we saw? Because it was really a mixed bag. It's only one data point. Really mixed bag. JP Morgan had what was, many would think were good results, but their stock got hit by it. Wells Fargo, not so good, but they actually did pretty well.
I think you said it perfectly, David. It was a bit of a mixed bag. On the one hand, this is a terrific year for banks. JP Morgan had a record year in terms of profitability. And I think one thing is certain, if we're correct that rates are getting back closer to neutral, higher short-term rates, steeper curve, it's really good for financial services. So those are the positives. I think the negatives are expectations are probably getting a little bit ahead of themselves. I think it's very hard to envision an environment where there's more deal making going forward than what we've seen in the last year and in the kind of numbers that we've seen this year. Those institutions with significant investment banking operations have done particularly well. And then lastly, as the CFO of JP Morgan said, they're targeting something like $3.5 billion in spending for technology and for acquisitions in technology. And remember what we talked about in December, which is that if you look at U.S. financial services prior to the crisis in 2008, about 95% of the market cap of financial services was the legacy banks. Today, that's closer to 70%, and we're seeing a big impact of technology platforms, monoline platforms competing with the banks. So I think there's a lot more competition. And so we're seeing costs increase. As you and I have talked about, that may be absolutely the right decision, but I think it was a bit of a surprise to the market.
Joanne, last word to you on this subject. Do you like banks for your portfolio, given where we are?
Yeah, we do. We do see those. We do see those rates coming up, and that obviously could help their net interest margins, but also recognize that a lot of people are now thinking the Fed's going to actually shrink its balance sheet potentially later this year. And they have a lot of longer term assets on that balance sheet. So that could also pull up the long end of the interest rate curve. And that also potentially increases their net interest margin even more than an increase in the short term rates. So we do think there's a fair bit of tailwinds in the outlook for banks. And we think they're an important, potentially protection against rising rates that will hurt some other valuations. And also we see loans rising over time. And not just the big money center banks, but also regional banks, I think, are a good place to be in this kind of a market because they're going to be more exposed to the increase in lending that we think is going to come along with continued economic recovery.
Bob Diamond and Joanne Feeney will be staying with us as we turn to the specifics of the tech sector and especially fintech. That's coming up. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Joanne Feeney of Advisors Capital Management and Bob Diamond of Atlas Merchant Capital are still with us. As we turn from the markets overall to one segment that has been particularly riled by the talk of higher rates, and that is the tech sector, and more specifically fintech. Bob, let me start with you. You've got some experience not just with banks, but also with tech, and specifically fintech with your major deal involving Circle. So give me your sense. Typically, it's thought that tech gets beaten up with higher rates. Is that true now? Is this a time not to invest in tech?
Well, again, come back to higher rates, David. We're talking about just getting back to neutral. So we're talking about maybe a 10-year in the higher end of 1.5% to 3%, and rather than the lower end. And we're talking about 2% Fed funds rate. So no, I don't think there'll be a negative impact. Our investments, our last 3 or 4 investments in Atlas Merchant Capital have all had a very, very strong tech angle to them. We're very, very positive overall on the fintech sector. Stable coins in particular, as you know, we announced in Concord Acquisition Corp a merger with Circle. And I think payments, technology, stable coins, the ability to impact the cost of commercial services, the opportunity to increase economic stability, all these things we think are very, very positive. So there will be winners and losers. I think there were periods in the market where anything with a tech angle, whether it was fintech or outside of finance, had a good bid. And I think it's appropriate that there are a little bit more selective in terms of the platforms that will be most successful. But within financial services, the impact of technology and the impact of technology-focused platforms is significant, and we really like it as a broad area to invest.
And I think that the news out of JP Morgan this morning just, really confirms that. They are spending because competition is up and they need to become more efficient. And where are they going to get that technology? Well, some of it will be internal. But if you go beyond the big money center banks, think of all the regional banks, community banks, they also need to become more efficient. And so a lot of the fintech names that are providing some of those capabilities, whether it's a smaller name like an nCino or a larger name, they got thrown out too. Over the last several months with all those multiples coming down. So, it's like the babies got thrown out with the bathwater over the last several months. And I think this year, we're going to see quality names really come back. So as Bob was saying, we're going to have to be really selective. But I think investors are going to start looking more carefully at the companies to see if they actually have customers, a well-defined market, and customers that have money to spend. And some of these companies have proved themselves already, and their multiples still got crushed. So I think there's a real opportunity for tech investing right now. You don't want to buy tech necessarily when it's really high. You want to buy it when the market is panicking and when the numbers have really come down, as they have over the last several months.
And Joanne, I would also say, you and I had talked about this, but there are sectors like using stable coins again, where we should really embrace and encourage clear regulation. And I think in the case of Circle, we certainly do embrace regulation. And I think that can also help separate platforms from those that are more investable than others.
And Joanne, I wonder if that takes us to another big story of the week, actually, was the nomination by President Biden of Sarah Bloom Raskin to be the vice chair of the Fed for supervision, because she worked when she was at Treasury. She worked specifically on regulation of crypto. I'm told she's one of the first people to say, we need to regulate this, and came up with a paper on it. So does that mean that we're going to have that regulation sooner rather than later, and maybe have it be informed?
Yeah, I think that's right. I mean, she has a stellar reputation. I think she's pretty highly respected, and she certainly has the experience in her various areas of work over the past many years to be able to think and lead discussions pretty well on that. But I think people, again, not separating which companies actually benefit from more concise, more thorough regulation and which ones might lose. You had the whole area trade down on the fear of more regulation, when actually it should be viewed as a positive for the development of products in that sector. And I think people probably misread that. So once again, going forward, I think we're going to get some clarity on the direction in which regulation is likely to go. And I think that could actually help some of the better companies.
Joanne, I couldn't agree more. I think there's a perception that, regulation is negative. Regulation is not negative. Good, sound regulation will make it more clear who are the winners and who are the losers, and which, can operate within a highly regulated financial services industry. My understanding is that the Fed white paper on stablecoins is coming out very soon, and I think that will add to some clarity around that as well.
So Bob, you've mentioned stablecoins a couple of times, and really focus, if you would, on the payment companies, because you do have experience. You've got investments in the area. What will be the difference between the sheep and the goats, if I can put it that way? Because there are a lot of companies out there right now. Which ones will survive and flourish, and which ones will fall by the wayside?
So there are stablecoin companies, or companies that are platforms that expect to be, that would prefer to be offshore, that would prefer to be outside of the regulatory perimeter. And I think those will be very challenged in terms of becoming, really used as payments. And there are others like Circle, which has said they plan to apply with the OCC for a full reserve banking license. That's how much they would prefer to be within the regulatory perimeter of the U.S. financial system. So I think we'll see it with more clarity, David, going forward. But I think we can see it, and there's already a separation from those that would prefer to stay outside of the regulatory perimeter and those that would prefer to operate inside.
Joanne, I'm really curious, again, for you as a portfolio manager, we hear increasingly people say, even who are skeptical of cryptocurrency overall, that there is a role in your portfolio for some of it, for various reasons. Do you feel that way? Do you look to balance, to some extent, have some role for cryptocurrency, whether it's stablecoin or a different sort?
Yeah, there can be a role for it. As Bob was saying, it's at this point a bit of the Wild West, right? Some are quality and they're really careful about adhering to what is likely to be regulatory frameworks that keep them safe, right, and create transparency. But we do create an opportunity for our clients to be involved in some of the cryptocurrencies. We like the ones that have a more grounded foundation in the underlying blockchain technology. But it's a bit hard right now to get too involved, because again, there's going to be a shakeout among those who are more careful about keeping those transparency, guardrails in place and keeping out some of the more nefarious activities that have been, used in those platforms, and also, the potential for hacking and other things. So one really has to be careful, but, it's clearly speculative, potentially a lot of upside, but also a riskier position. So one wants to limit exposure, I think, that realm at this point.
And listen, the impact on the economy can be real. If you look at, being able to do commercial payments, not consumer necessarily, but business to business, instantaneously, 24/7, on a weekend, in the middle of the night, at the speed of the internet, but also with the cost of those transactions being driven virtually to zero. This can have a significantly positive impact on the economy and on inclusion in the financial services.
And just to mention where I can do it through my bank account, actually, my main bank account. Thank you so much. Great having both of you with us. That's Bob Diamond of Atlas Merchant Capital and Joanne Feeney of Advisors Capital Management. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time to look ahead to next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. It is a big week for China watchers. GDP data on Monday may show growth slowed to the weakest level in 1.5 years in the fourth quarter, with COVID hitting consumption and the property market in turmoil. Meanwhile, the monthly data dump will give a glimpse of economic activity going into the new year amid concerns a surge of Omicron cases could derail economists' already weak outlook. So watch for potential further stimulus from the PBOC. The Bank of Japan hands down its first policy decision of 2022 Tuesday, while November industrial production figures are also released. And later in the week, rate decisions from Indonesia and Malaysia. Now over to Danny Berger in London. Danny?
Thanks, Juliet. On Monday, we have a Eurogroup meeting in Brussels. It'll be the first one with France holding the presidency. We're expecting fiscal rules to be high up on the agenda. The following day, we get European car sales, and it really will be a busy week when it comes to corporate stories in Europe. We also have earnings from the like of luxury good companies like Richemont, as well as Burberry. Now, we'll also have a bevy of central bank decisions on Thursday. They include Norges Bank, Turkey, and Ukraine, which of course each individually have their own idiosyncratic political issues. Now, speaking of politics, we'll also be closely watching the UK as Boris Johnson faces tough questions over his actions during the height of the first lockdown. He apologized for a party he attended at 10 Downing Street. We've seen him suffer and his party suffer in the polls. So we'll watch how that unfolds over the following week. Now over to Romain Bostic in New York.
Thanks, Danny. A three-day weekend ahead with U.S. equity and bond markets close Monday for the Martin Luther King Jr. holiday. When they reopen on Tuesday, they're going to face a deluge of corporate earnings as the season picks up. The remainder of Wall Street's biggest banks, including Goldman Sachs, Morgan Stanley, and Bank of America, are set to publish reports during the week. That comes on the heels of mixed results this past week from Wells Fargo, JP Morgan, and Citigroup. Also look for earnings from United and American Airlines, Procter & Gamble, and Netflix. Netflix shares are down 25% from their all-time high 2 months ago, including a more than 10% slide to start this year. The streaming company has become a bit of a barometer for investor risk appetite. The stock has one of the higher multiples among the heavily weighted tech names in the S&P 500. Netflix earnings are scheduled for after the closing bell on Thursday. David?
Thanks to Juliet, Danny, and Romain. Coming up, it looks like Fed Chair Jay Powell is headed toward a second tour of duty. But what confronts him this time may be very different from what he's seen before. We ask former Fed Governor Dan Tarullo of Harvard.
They could dust off a lot of the tools from the 80s, the output gap analysis, Phillips curve.
This is Wall Street Week on Bloomberg. Economic defender of last resort. Since the great financial crisis of 2008, it's been the Federal Reserve we've depended on to bail out the economy when things got rough.
The ongoing labor market slack and the subdued inflation outlook are key reasons for the committee's decision to maintain the current high degree of monetary policy.
Monetary policy will likely remain highly accommodative for quite some time.
But now we face something we haven't seen for a while. A Fed bent on tightening rather than loosening, with Chair Jay Powell testifying at his confirmation hearing this week that quantitative easing has to come to an end.
We'll be normalizing policy, meaning we're going to end our asset purchases in March.
That rate hikes are coming this year.
If we have to raise interest rates more over time, we will.
And that the Fed's balance sheet is just too big.
We're mindful that the balance sheet is $9 trillion. It's far above where it needs to be.
In short, that the economy no longer needs the sort of monetary policy support the Fed has been providing for over a decade.
The economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath.
And so, as Jay Powell is on the brink of being confirmed for a second term as chair of the Federal Reserve, it's time to think about how different the next 4 years may be from what came before.
And to help us take a look at what the Federal Reserve has in store for it coming up, we welcome now a former member of the Federal Reserve Board. He is Daniel Tarullo. Dan, thanks so much for being with us. It's been one thing to manage the Fed. It's not been easy, I'm not saying, when we were loosening monetary policy, supporting the economy. How difficult will it be if and when Jay Powell gets confirmed as the next chair to really have a very different regime?
Well, David, it's true. For the first time, really, in about 40 years, inflation is the part of the dual mandate that's front and center, if not standing alone, at least much more prominent than it has been. And essentially what they're confronting here is they've had, of course, a major supply side shock in the form of the virus, of uncertain duration, with literal variants that keep mucking up people's efforts to analyze when the effects will pass through. At the same time, they've had an awful lot of fiscal stimulus over the last couple of years. And so when you have reduced supply and increased demand, predictably, you've got inflation of a sort that we haven't seen in some time. Now, the Fed spent most of 2020 telling itself and us that they thought that inflation was going to be transitory because it was grounded in those supply side effects, people not going to work, not being able to get things around the country and the like. Obviously, they're not holding to that line anymore. And the implicit policy implication of their view last year that they didn't really need to do much has now obviously been abandoned. But they now need a new hypothesis as to the trajectory of inflation and what will cause it to perhaps recede, what will cause it to embed itself. And that's really, I think, the first order of business on monetary policy for the Fed this year.
Do they have, as far as you can tell, a theory of the case at this point? What are they managing this for? As they say, we have to get inflation down. We heard that from both Fed Chair Jay Powell as well as Larry Brainerd this week. They agree on the goal, but do they have a theory about how to come about with that goal?
Well, they have. I wouldn't have expected that at confirmation hearings they would have put forth a more or less nuanced monetary policy view. So I don't know what their operating theory is now, but it's surely not just going to be last year's. I mean, there are several options, right? They tend to talk about expectations a lot. That is, well-grounded inflation expectations in the public and markets, keeping inflation down. That's a hard one to judge in real time, and nobody really quite understands why expectations change. They could dust off a lot of the tools from the 80s, the output gap analysis, Phillips curve, the relationship between inflation and unemployment, wage price cycles, and try to apply that right now. Or they could come up really with transitory version 2, which would basically say, look, we think the medium-term or longer-term disinflationary forces in the economy, globalization, demographics, and the like, are still at work. And so we don't need to make major adjustments in monetary policy, but we do need to make some. So those are at least 3 possibilities or some combination of them. But I haven't seen anything yet that would give us a hint as to which particular blend of those notions the Fed is going to adopt. What's important, David, though, is that they do articulate, as you put it, a theory of the case so that they can then judge incoming data against that theory, and that allows them to make policy adjustments as appropriate.
Everyone is concerned, I think, first and foremost about what was called a policy error, policy mistake at this point. I saw some analysis done at Bloomberg, actually, that there's been 11 times since 1914 that the CPI has been over 5%, and in 8 of those instances, a recession occurred afterwards, and the 3 when it didn't, we had 2 wars and a depression going on. What would be the riskiest thing to take us toward a policy error in terms of formulating a theory of the case?
Well, the problem is they've got risks on both ends. That is part of the explanation for the historical observation you just made is the Fed will sometimes hit the brakes extremely hard and thereby cause a recession. Engineering the proverbial soft landing is not an easy thing to do. On the other hand, as we saw in the 70s, where the instinct may be just to tap the brakes a little bit, and it turns out there's a lot more inflation momentum, then you get into a situation in which inflation truly does become embedded in the economy, and that leads you to the Volcker-like approach, which was really, really very difficult medicine to swallow indeed.
Dan, we saw someone you know well, Jay Powell, the current chair, and it looks like future chair as well of the Fed, testify this week. I wonder, as an institutional matter, what the challenges are that he may be facing, because the Fed is really coming under a lot of scrutiny right now, and there also is going to be a fair amount of turnover. There are quite a few new people who will come on board. What are the challenges for the chair in that world?
So it's a very good question, David, and it comes, at a complicated time because, as we were just discussing, monetary policy is not going to be an easy mission for the next 12 to 24 months. Essentially, the Fed is no stranger to attacks from the public, from members of Congress, even from administrations. But when that happens, the chair has historically needed to spend a good deal of time addressing those attacks or those challenges or those concerns, both in the public eye, but also, where appropriate, taking steps internally. And so, for example, right now, with all the questions around the trading of 3 members of the FOMC, which led to their resignations, obviously, that's something that the chair needs to address, and he needs to do it in a way that convinces the public. At the same time, as you say, he's got another institutional challenge, which is 3 new members of the board coming on, each of whom is going to want to carve out his or her role. It's not an easy thing at the Fed because there are really only 3 jobs that are well defined, the 2 vice chairs and the chair. And so, as I saw Ben Bernanke and Janet Yellen do, they need to work with each governor to give that governor a role that allows him or her to channel their interests while at the same time doing it in a way that helps the board. And, David, a real risk would be if the board is kind of fractious publicly. There are, contrary to a lot of public views of some commentators, there's a lot of disagreement on the board a lot of the time. But most of the time that gets hashed out on the governor's card at lunch. And then the board makes a real effort to try to give a coherent view of what their agreed position is, because communication is such an important part of monetary policy. If you don't have that situation, it's one thing for a Reserve Bank president or 2 to be off with a different message. That happens all the time. It's not a problem. But if you have members of the board dissenting either technically at FOMC meetings or effectively through their public statements, that just makes monetary policy all the much harder to effectuate.
Yeah, whatever it is, it's going to be a big job for Jay Powell going forward. Thank you so much to Daniel Tarullo of the Harvard Law School. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This This is Wall Street Week. I'm David Weston. We are delighted to welcome back once again our special contributor Larry Summers to Wall Street Week. So Larry, we had a lot of data flow this week, and I'd like your reaction to it. And let's lead off with the lead, which is those CPI numbers of 7%. It's been a good long time since we've seen that kind of number.
It has, David. Richard Nixon imposed wage price controls when inflation was about 2/3 as high as it's been last year. This is above any place it got during the guns and butter Vietnam inflation. I think the data flow is saying what I've thought for quite some time, that yes, there are transitory elements in inflation and very likely they will recede, but we are basically moving towards higher entrenched inflation. It's there in expectations, it's there in wages, it's there in labor shortages. It's there in the pervasive pattern across many different prices. And people try to excuse it by picking this figure and that figure from month to month. But we've got an overheated economy, and the Fed's going to have the very real challenge of cooling that economy off. And doing it in a controlled way. That has not been done very successfully in the past. So it's going to be a very challenging year for macroeconomic policy.
And I suspect that the approach depends on what the causes are of the underlying inflation. And we have various candidates put forward. For example, we talked with Brian Deese, you know him well, from the White House this week. He said, well, really, this is a supply side problem. Once we get the supply chain fixed, it'll be all fixed. Is he right?
No. He's wrong. We have a massive overheated labor market. We have the highest ratio of vacancies to unemployment in the country's history by a large margin. We have shortages of labor in everything from psychotherapy to McDonald's, in everything from investment analysts to gardeners. That suggests a surfeit of purchasing power and demand relative to the capacity of the economy to produce. And unless we bring those things into balance, we're going to have not just higher inflation, but possibly even accelerating inflation. And we need to recognize that we have an overheated economy that we are going to need to cool off in the time to come. And until we do that, it is going to be much more difficult to address the problem. Yes, we need to do what we can to open up ports. Yes, if there was anything we could do to cause there to be more semiconductors, that would be good. Yes, better child care arrangements to enable more women to work would be desirable. But fundamentally, this inflation is about an overheating economy, and that's the thing that we have to address. Every time a Washington policymaker suggests that this is caused by corporate greed or some such, they are delaying the date at which we will achieve the credibility necessary to bring down inflation with stable employment. They are raising the risk that we are going to need the kind of, which I sure hope we can avoid, and I think we can avoid, the kind of drastic contraction that was necessary when Paul Volcker became chairman of the Fed. But misdiagnosis of the problem around greed or around particular sectors raises the risk that ultimate recession will be necessary.
All of which takes us back to your statement that it's pretty difficult for the Fed to have a soft landing here. The track record is not unblemished, I think it's fair to say. With the 3 new nominees from President Biden, he will have basically put 5 people in place, renominating Jay Powell as chair, promoting his proposal as promoting Lael Brainard, and then 3 new members. What do we know about these people? What does it say about the constitution of the Fed going forward, assuming they get confirmed?
Let me say that I strongly support the reconfirmation of Jay Powell, and I strongly support Lael Brainard's nomination to be vice chair of the Fed. I think that the 3 new nominees who don't have a track record on the Fed will have an opportunity to present their views on inflation and on the challenges they will face in dealing with an overheating economy. The president has made clear his commitment to the independence of the Fed. Part of that commitment is allowing and encouraging the Fed to be focused on its fundamental jobs of maintaining a non-inflationary economy with as strong employment as is possible on a sustained basis. If a sense develops that there's a desire to politicize the Fed by focusing it towards other issues beyond the crucial issues of financial stability, I think that could be problematic for the Fed's credibility. And so it will be very important for the nominees who have distinguished track records in different areas in the past to present their views to Congress, and for Congress to very seriously consider those views.
Finally, Larry, we can't summarize the week without talking about COVID-19 and the Omicron variant, as we have record numbers this week coming in, at least of the disease being contracted. I'm curious about where you think we are in dealing with the pandemic, and more pointedly, in the past on this program, you questioned, particularly during the Trump administration, the competence of the government. Were they demonstrating competence in the way they handled it? At this point, is the Biden administration demonstrating competence in the way it's handling the pandemic?
It is so much easier to be on the outside and criticize and carp and judge things in retrospect that I'm reluctant to pass judgment on what the Biden administration has done. Certainly, we now need to be focused on much more than vaccination, on rapid dissemination of treatment, particularly on the availability of tests. I wish those things had happened faster. I wish the CDC and the FDA had broken more out of their conventional rhythms to reflect the extraordinary situation that we're dealing with. But I would underscore one thing, David, and that is that COVID anywhere is a risk of mutation that could lead to catastrophe everywhere. And that we are underinvesting as a global system on a massive scale in the global effort to contain COVID. And in addition to its moral significance around the world, we are making it more likely that the next vaccine, the next COVID strain will have Omicron's transmissibility and some other strains' lethality. And that is a grave risk to the global system, and one that I think is not getting enough attention. You know, one of the things that I think is very, very important in government is to hope for the best, but to plan for the worst. And I think in a whole set of areas that the administration, even as it tries so hard to present an optimistic vision, and that is so important to do, needs to be insuring against the downside outcomes. And global COVID is one of those outcomes.
Okay, well said. Thank you so much, Larry. It's always a delight to have you. That is Larry Summers, of course, of Harvard University. Coming up, when sports and Omicron collide, are superstar athletes really different from you and me? This is Wall Street Week on Bloomberg. Finally, one more thought. Playing by the rules of vaccine mandates. Everyone is talking about them, from banks saying that if you don't get the jab, you can't keep your job, to the Supreme Court ruling that it's up to Congress, not the president, to make them universal.
In early 2020, while millions stayed at home, millions of healthcare workers heroically stayed at work. These same workers are now forced to choose between losing their jobs and complying with the government's vaccine mandate.
It's one thing to try to tell your employees what they need to do to come to work. It's quite another when it's an independent contractor who makes tens of millions of dollars a year, has a vocal global fan base, and, oh, by the way, is arguably the greatest of all time. That's what Australia has on its hands in Novak Djokovic, looking to break his tie with Rafael Nadal and Roger Federer for the most Grand Slam wins ever by a man. And, oh, by the way, he's an outspoken skeptic of vaccinations. Mr. Djokovic has been, shall we say, a bit cagey about his vaccination status, invoking instead his claim that he caught the virus, recovered, and is therefore immune. All of which got him into the country, only to have the government say it wasn't enough and he'd have to leave and say goodbye to that 21st Grand Slam title, which put the issue in the lap of the courts of law and the courts of public opinion, as tensions continued in advance of the start of the Australian Open next week.
Rules are rules, and there are no special cases.
But it's not only tennis stars playing a bit fast and loose with vaccine mandates these days. We have the infamous case of NFL quarterback Aaron Rodgers, who was forced to sit out when it turned out he really hadn't been vaccinated after he'd led everyone to believe that he had.
I made a choice that was in my best interest. You might respect it, you might hate it.
And, of course, not far from Wall Street, superstar guard Kyrie Irving of the Brooklyn Nets hasn't been able to play at home all season long, although his team needs him so badly, it is now starting to let him play on the road where local authorities permit.
I understood their choice to say if you're not going to be fully vaccinated, then you can't be a full participant. And I knew the consequences. I wasn't prepared for them by no stretch of imagination.
But all that may pale in comparison to what China has in front of it, trying to keep to its zero COVID policy with hundreds of athletes through an entire Winter Olympics.
With one city closed of about 11 million people, and now cases of Omicron found in Tianjin, which is just, around the corner from Beijing, and an Olympics coming up in less than a month. All eyes on China right now.
So if you think you're struggling with your version of a vaccine mandate, just think about the poor Australians, or the Chinese, or for that matter, the NBA. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.